Nobody likes paying tax. And here in Australia, there are ways that the rich actually use their portfolio to be able to minimize their taxes to actually go and make so much more wealth over the long term. And this is such a big advantage for the rich getting richer and unfortunately the poor getting left behind because we don't actually have access to this information. So in this video, I'm going to jump into my whiteboard, show you exactly how the rich do it, and it's something that you could implement later on, as this is quite an advanced strategy. If you're interested in learning more, then definitely keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, if you are interested in a free ebook, that I've got linked in the description below, so you can go and download it. It's a bit about my story and more around how you can get started with property and how to build out your property portfolio as well. And yes, it is completely free. And with that, let's jump in. I wish there was a channel like this when I had started property investing like 10 years ago, but there wasn't, and that's why I'm here making these videos. The rich get richer because they know who to talk to, get educated about the right way to do things and of course the wrong way to do things, and they double down on those things to really grow out their wealth. Unfortunately, many people get left behind because we actually don't have access to that information. So I'm going to do my best to break it down and see what the average person is doing and what we can do in our own lives to really upgrade our wealth. Now I'll give you some context, so bear with me. But most people will have a job, and from that job you'll make an income, and on that income you are paying taxes, right? Now what will most people do is they will go and purchase their own home, and they will repeat this process of earning from their job, retire with their home probably paid off, but at that point you're now relying on the government for retirement. So you're not self-funded, you're relying on the government system here, which is providing you the pension. And if that's not enough money for you, bad luck, because at that point you're probably finding it difficult to find a new job. And this is what most people are doing. Now let's go across to what the rich people are doing, and then we can start learning from that. So what the rich people are doing is most likely earning an income from their business. And what they do is they pay less tax, but they go and pay themselves, but they pay themselves a minimum wage. So something they actually need. So let's say you've got an example of someone making $100,000. Now you get taxed, and let's just break it down and say you get taxed at 30%. So 30% is gone, now you've got 70K left. Now you've got paid the 70K. Your expenses to live your own life, maybe only $40,000. So the difference between the two is savings, right? Now in that case, you still had to take the 100K worth of income, which meant you got taxed on everything. As a business owner, you could go and have the business operate at a net profit, but you don't have to pay yourself everything. And this is what happens. Business owners could pay themselves a lot less and cover off their expenses, which means they're getting taxed a lot less there, and business profits are getting taxed even less than that. So this really sets them up straight from the beginning to have as much income available to them to go and invest. And that's what they do next, is they will go out, use that money and invest, and that allows them to retire early. So not just be self-retired, but retiring early self-funded. That means they have the choice. And so let's say you're watching this channel and you've got one property, or you're trying to attain a property portfolio. You sort of sit there at some point and go, why am I doing this? And the reason is because in 30 or 40 years time, depending when you start, you're hopefully relying on the income those properties generate for you to be able to then pay for your own living expenses. Versus in the first example where you try and buy your own house and then you go and rely on the government to give you money. This way you are your own government. You are your own bank. You will use that money and pay yourself how you like. Now some of that money might be invested, some of it just might be sitting in your bank account, but you have the choice. Now that's not to say that rich people don't go and buy their own homes. We see it plenty online where celebrities buy a $20 million house. And I'm not saying that you shouldn't. I'm just saying that this is the system they work with. And what they do then is once their portfolio has grown to a certain level, they may then take that money and then buy their own place. So they might rent vest in the beginning. That's something that I'm doing at the moment. But equally, they could go and buy a property. But if they know how the tax system works and they've got a good tax structure, then they're in a position to go and invest more earlier into that market. So let's look at how property can actually help in this scenario. You might be here watching my channel to know how it works with property investing. So when we go and get debt from a bank, we go and use that money to buy our own home, right? Our principal place of residence. In this scenario, the reason why they call it bad debt is because the debt has no tax deductions, okay? Now, if you go ahead and use the same amount of debt from the same bank, but you now invest in an investment property, that tax is now productive. And that tax is productive because it reduces your taxes. There's a tax deduction. Now, I am definitely not a tax expert. I know the basic stuff, but you should definitely go and reach out to the tax professionals out there. There are plenty good accountants out there that can actually do a good job and structure you properly and are actually legally allowed to talk about it. I can give you high level stuff, but you need to take this knowledge and go to them. So while I think that is pretty common knowledge, some people may not have known that, but now we're stepping up into the advanced level. Let's see what they're actually doing. So when you earn an income, you pay more tax. Fairly obvious, right? I get a lot of flack on this where you're like, hey Ravi, I'm buying a positive cash flow property. How does this reduce my taxes? I'm like, you're looking at this wrong. If you're making more money, that's actually a good thing. You wouldn't run a business to lose money. You'd run a business to make more profits. As a result of making more profits, you pay more tax. So in this case, you earn income and you pay more tax. But what about if we treated our debt as income? Now, you might be going, what the F at this point? Because debt is not income. Now, let me break this down for you. Be patient, but I'll get you there. Now, a property really has two main sources of wealth creation. You've got the rental income, which is taxed, and you have capital gains, which actually incurs no tax. And the reason is because debt is not taxed. Income is taxed, okay? Now in this case, if you actually sold this property, then you pay capital gains tax. But in this case, if you have capital gains in the property, so let's say you bought something for 500K and now it's worth 700K, you're not actually realizing a taxable event. You're not selling your property. What you could do is access that debt in the form of equity. So what the rich are doing, and hopefully you guys are falling into this bucket now, is that if you can go and purchase a property this year for $450,000 and it grows in a year to $500,000, that is $50,000 worth of growth. Now, you could go and extract that debt out in the form of a line of credit or an equity top up. And what that means is you're basically going to the bank and saying, look, I've given you this property to hold and I'm taking debt against it. I pay you interest on it, so you're happy. But what I want to do is I want to use some of that equity to be able to go and live my life, or I want to go and invest somewhere. The banks are going to go,
yeah, you're taking out more debt and you're going to pay more interest. Yeah, sign me up. This seems like a no-brainer.
And for you, if you can use this productively, then you will go and beat the system time and time again. It compounds, right? So it may not seem like a lot in this example, but if you do this year on, year out, or you do it every 5 years, you suddenly get ahead a lot faster. And this is how it works. You compound that growth, and over the long term is when you see the benefits. So in this case, let's say you've got $50,000 worth of equity at 90%, you've now got $45,000 worth of equity you take out. Now you could use that money and pay yourself $900 per week tax-free. And the reason it's tax-free is because it's not actually income, it's actually debt. So in the bank's eyes, it's equity that you're now using, but effectively it's still debt. Now I've got to give you a caveat here, is that just because I'm saying that you could go out and do these things doesn't mean it's actually a good idea. I don't give you that sort of financial advice. You've got to rely on your own situation and understand if it's debt that you can actually take on. All I'm showing you is that this is possible and this is what people are doing out there. I'm not saying whether it's good or bad, I'm just saying that's how the system works. Now, why would you actually do this? It's because debt is tax-free, whereas income is taxed. So if I still go and pay myself $50,000, I'm going to get taxed on that day one. But if I go and use the equity in my property and pay myself $900 a week, I pay no tax. Now, if I don't pay tax in that situation versus someone making $50,000 from an active income and they have to pay tax, well, guess what? I've got 30% more purchasing power from the beginning. So I can go and use that money and invest in something. So if I wanted to buy $50,000 worth of shares, I could go and do that because I pay no tax. But for someone else who just earned $50,000 has to pay tax of 30%, and then they can go and invest in that market. So again, my asset base is a lot higher because I get to avoid having to pay tax up front. At this point, I'm saying tax so many times, you should probably hit the like button before I lose my mind. So the rich are using debt as their income. You'll hear often that if you have a portfolio worth a couple of $1 million, you could go to the bank and say, look, just pay me $100,000, I'll take out equity. And let's say their properties are actually increasing by 7%, yet they're only taking out 3 to 4%. You're in this infinite money loop where the properties keep growing in value, but you're just using a portion of it to pay for your living expenses. So effectively in that case, you would have actually retired. Now there's two main conditions to this. One is that your borrowing capacity needs to be in check. So if you don't have a borrowing capacity, you can't access the equity. And then you need an appreciating asset. If you go and buy your own home or you go and invest somewhere and you're like, okay,
I'm going to wait for the 10% growth.
Year 1 goes, year 2 goes, year 3 goes, and then maybe year 4, you're like, oh, I got my 10% of growth, but I also needed money for the last 3 years. So what I'm saying here is that you could buy a dud investment and it doesn't appreciate in value, which means this system doesn't work. This relies on you actually purchasing a good investment, a good property that's actually going to go up in value. So let's look at my client strategy. If I was to look at the majority of my clients, what are they trying to do as part of the buyer's agency? If you want to understand how that all works and how we help clients, definitely go check out this video. It's free, it's on YouTube, it's like 35 minutes and you'll learn a shitload. Now in this case, what they're doing is they're trying to create the foundation to their wealth. And that usually is in the form of $2 million worth of assets. Now I'm not saying, hey, buy $2 million worth of assets today. No, some people are in a position where they're going to build it over the next 5 years because that's what they can afford. Others have the cash already up front, which means they can go and build way beyond 2 million straight away. Everyone is different. So again, it's It's not about you comparing to someone else's situation. It's about how can you better your life from what you were living only a month ago. And that is the whole idea of investing. It's a personal journey. My goals are different to your goals, and your goals are different to someone else watching. So why would you compare what you're getting to someone else? So now if they're going out and they're wanting to purchase $2 million worth of assets, that could be in the form of $400,000 homes. Keep it real simple, that's $2 million. Now at 5% growth, that means $100,000 a year is being generated in equity. $100,000 at 90%, because the bank will usually give you 80% or 90% of that equity value. That means $90,000 worth of income that person could now use tax-free every single year. As long as they can make the repayments, as long as they have the borrowing capacity to go and access that equity, they make $90,000 a year tax-free. Now at this point, your head might be spinning, or you might be understanding this, or you're actually already doing this. But you're now wondering, okay, if equity is now being used as income and I get no tax on it, that's free money, but aren't I racking up more debt? Yeah, you are. And if you're interested in knowing how you pay off that debt eventually, then definitely comment down below part 2 with the debt, and I'll make that video for you guys next. I hope you guys have enjoyed this whiteboard video. If you have, smash that like button, subscribe if you haven't already. I've got a bunch of whiteboard videos on this channel, so definitely go check them out. I'll catch you in the next one. Thanks guys.